While everyone's buying AI stocks at 50x earnings, Harry just made the opposite move. He bought 3 stocks that Wall Street gave up on. Stocks trading at massive discounts, with real income, real assets, real turnaround plans. And here's the kicker. Each one has smart money pouring in quietly. That's not noise, that's a signal. The question is, will you spot it before the crowd does? Let me introduce you to Harry. Harry's 34, works in tech, makes good money but realized he was terrible with his finances. 2 years ago, Harry was buying whatever was hot. Tesla at $300. Nvidia at the peak. Sound familiar? Then Harry discovered something. The best way to build real wealth happens when you buy great companies that everyone hates. When you focus on the actual business instead of the headlines. These 3 stocks could transform Harry's approach from gambling to genuine long-term growth. Each offers something different: steady income, turnaround potential, and hidden value that Wall Street is missing. But here's what's really interesting. Each of these companies has fundamental strengths that the market is completely ignoring. That's not coincidence, that's opportunity. Stock number 1, Target. The digital story. Nobody sees. Everyone thinks retail is dead. Amazon killed it. E-commerce destroyed everything. Target should be roadkill, right? Wrong. Here's what's actually happening at Target that nobody's talking about. While their physical store sales dropped 5.7%, their digital sales grew 4.7%. But that's not the real story. The real story is something called Target Circle 360. This isn't just another loyalty program. Target has turned their platform into something bigger. They're partnering with over 100 other retailers. When Harry orders something on Target.com, he might also see products from Best Buy, Ulta, or dozens of other brands. Target takes a cut of every transaction. Think about that business model. Target becomes the middleman for multiple revenue streams. This creates passive income at corporate scale, money flowing in from transactions they don't even fulfill. But here's the data point everyone missed. Same-day delivery services grew over 35% in the latest quarter. That's not just growth, that's acceleration. Target is building a logistics network that competes directly with Amazon Prime. Their Kate Spade collaboration was the strongest designer partnership in the last decade. Valentine's Day and Easter performed better than non-holiday periods, showing Target can still drive traffic during key shopping moments. The numbers are compelling. Target trades at 12 times earnings, while competitors like Dollar General trade at 18 times. That's a 30% discount for a company that's actually innovating faster than its peers. Target generates a 14% return on the capital they invest back into their business. That crushes most retailers. Plus, they pay out 4.5% annually in dividends, immediate income, while the transformation unfolds. Here's what I think is happening. Target isn't fighting Amazon. They're building something Amazon can't replicate. A physical-digital hybrid where you can touch products before buying, then get them delivered same day. Based on their cash flows and this transformation, I think this stock is worth $135 to $145. It's trading around $102. That gap represents genuine opportunity for retirement savings-focused investors. But Target's just the warm-up. The next stock has an even more compelling comeback story. Stock number 2, Nike. The comeback nobody expects. Nike is having its worst year in decades. Revenue down 12%. Profits collapsed 86%. Stock trading 60% below its highs. Wall Street has written the obituary. I'm buying more. Here's what everyone's missing about Nike. This isn't permanent decline. This is strategic restructuring disguised as failure. Nike's win now strategy sounds like corporate nonsense, but it's actually brilliant. They're abandoning low-margin partnerships and focusing on high-value customers. They're pulling back from discount retailers and investing in direct sales. Short-term pain for long-term wealth building. The Amazon partnership everyone thought was dead? It's back. Nike realized they need every sales channel to compete. This relationship could generate $885 million in additional revenue annually. That's nearly $1 billion Nike left on the table before. But here's the real competitive advantage. Nike's brand strength is unbreachable. Ask 100 people to name the top athletic brand. 90 will say Nike. That's pricing power you can't manufacture. Here's the key insight. Nike averaged a 20% return on invested capital over the past 5 years. Even during this difficult period, they generate exceptional returns on money put back into the business. That's quality hiding behind temporary headwinds. The supply chain diversification away from China is nearly complete. Nike has reduced their dependence on Chinese manufacturing significantly, which addresses tariff concerns and creates operational flexibility. Inventory levels have normalized. The fourth quarter likely marked peak promotional activity. The clearance sales are ending. Cleaner inventory means better margins going forward. Nike's innovation pipeline remains strong. The Vomero 18 and Pegasus Premium are generating buzz. Their collaboration with Skims could be a massive Q4 catalyst if it resonates with target demographics. My analysis suggests fair value around $90 to $100 per share. At $74, that's 20 to 35% upside for patient capital. Nike isn't broken. They're restructuring for the next growth phase. This is how generational wealth gets built, buying quality companies during temporary difficulties. But our third pick might offer the most compelling risk-adjusted returns. Stock number 3, Southwest Airlines, the hidden income machine. Southwest Airlines is everything investors supposedly hate right now. Domestic travel exposure, fuel cost, sensitivity, Boeing delivery delays. I see something different. Southwest has unencumbered assets worth $16.6 billion, investment-grade credit ratings, $3.8 billion in cash. This balance sheet could survive another pandemic. But here's the income story nobody talks about. Southwest pays 72 cents annually. That's 2.4% yield. They've maintained this dividend even while earnings fluctuated. Yes, they're currently paying out more than they earn. But with nearly $4 billion in cash, they could maintain these payments for years even if business stays pressured. For someone like Harry focused on retirement planning, that's predictable income while waiting for recovery. Here's what's really interesting about Southwest's recent moves. They successfully launched bag fees with financial benefits exceeding expectations and zero negative operational impact. That's pure margin expansion. The assigned seating rollout is generating excitement. Premium cabin options are being tested. New fare bundles give customers more choices while creating upsell opportunities. Southwest's partnership with China Airlines and Icelandair opens international corridors they've never accessed. Their point-to-point model could work brilliantly in trans-Pacific markets where other airlines use inefficient hub-and-spoke systems. The fuel hedging termination actually strengthens their position. Southwest eliminated $209 million in future premium costs while gaining immediate exposure to declining fuel prices. When oil drops, Southwest benefits immediately. Their operational efficiency remains unmatched. Quick turnaround times from the all-Boeing 737 fleet. Point-to-point routing that avoids congested hubs. These advantages become more valuable as air travel normalizes. Based on normalized earnings and Southwest's historical profit margins of 10 to 15%, I see fair value around $42 to $47 per share. At $30, that's 40 to 57% upside potential plus dividend income. Southwest isn't broken. They're adapting their low-cost model for premium customers while maintaining operational advantages. Here's how Harry's building long-term wealth, one contrarian move at a time. Target gives him exposure to the digital retail transformation. Nike brings global brand dominance and pricing power. Southwest delivers income now, and upside when travel rebounds. 3 different companies, 3 different economic cycles. One goal, financial independence. Each one is beaten down. Each one is backed by smart money. And together, they create balance, income, growth, and diversification. The key? Position sizing. 5 to 7% of your portfolio in each. Enough to matter, not enough to wreck you. This isn't meme stock gambling or chasing hype. It's disciplined, fundamentals-based investing with asymmetric upside. The power of compounding doesn't come from timing the market. It comes from buying great businesses at great prices and holding on while everyone else panics. So let me ask you, are you ready to buy what everyone else is selling? Drop a comment with the stock that interests you most. And if you want more breakdowns like this, hit subscribe. We're building a serious investing community here, focused on real money, real strategy, real independence. This video is for informational purposes only. Do your own research and always consider your risk tolerance. But remember, the best opportunities often hide where others fear to look.